Welcome to this session. In the previous session, we have discussed that how government safety net led to the aggravation of asymmetric information problem in the financial market, and which created the problem of adverse selection and moral hazard problem, and also we have seen that it created the problem of too big to fail. And then we have seen that there was several bank failure became more prevalent in the 1980s. One of the reason for the bank failure in the 1980s was the existence of Deposit Insurance Corporation, and the further reason was because government is standing as the lender of the last resort, and also the problem of too big to fail, and government standing as lender of the last resort. All this aggravated the problems. So further we can also see that in the 1980s, since the banking systems was looking for financial innovation to earn more and more profit, because the traditional lines of business is not, they realize that the traditional lines of business is not going to earn the more profit, because decreasing profitability of the traditional business and increased direct finance through commercial papers. Commercial banks were forced to seek out new and potentially risky business to keep their profits up by placing a greater percentage of their total loans in real estate and in credit extended to assist corporate takeovers and leveraged buyouts. So all this led further all to adding fuel to the fire. Financial innovation produced a new financial instruments that widened the scope for risk taking. So they also invested in junk bonds, and they also issued commercial, mainly junk bonds as well. So all as a result, what we can see that, there was a large bank failure in the 1980s. And further reason, we can also see that the financial consolidation that also contributed to the challenge. So larger and more complex financial organization challenge the regulation. One is that the increase too big to fail problem became aggravated because the financial consolidation, the merging of several financial institutions, financial and non-financial institutions, their complex relationship further aggravated the problem of too big to fail. The increased size of financial institution resulting from financial consolidation increases the too big to fail problem, because there are now more large institutions whose failure would expose the financial system to systemic risk. Thus, more financial institutions are likely to be treated as too big to fail, and the increased moral hazard incentives for these large institutions to take on greater risk increases the fragility of the financial system. And second, the financial consolidation of banks with the other financial services firms means that government safety net may be extended to new activities such as securities, underwritings, insurance or real estate activities as occurred during the global financial crisis. So that means this increased the incentive for risk taking in other areas as well, new activities, that is real estate, insurance, etc. Because the people have witnessed that during the 2007-8 crisis, it was the banking sector which was the worst affected sector, financial sector, and then they have been bailed out because government followed that because of the too big to fail problem, government bailed them out. So actually then this issue spread to other sectors as well. So overall there is less incentive for large depositors, especially pension funds. Normally pension funds, they will be monitoring their investment, whether wherever they invested. For example, they have invested in bond market, they will be monitoring the bond issuers financial activities, project activities. Now they have less incentive to do the monitoring. So all these things further contributed to the weakening health of the financial market. So in this context, let us see how merger normally we see that merging of banks is going to increase the profitability. I am just taking the screenshot of one of the newspaper clippings. So we normally, by reading this, we can see that okay, so because when merging of banks, associate banks with the SBI, so theoretically we expect that it is going to increase the efficiency because they will be having economies of scale and economies of scope. So clearly we can see that is going to increase profitability. But at the same time, we can also see that the points that we have discussed till now, so far, we know that is going to create, that means merging, then SBI is going to become too large, right, too big to fail. So when it is becoming too big to fail, it actually incentivizes this bank to make a risky investment, because anyway government is going to bail out if they fail, and the investors, the depositors with SBI, the deposit, even with the individual depositors and the institutional investors, depositors like pension funds and all, they have less incentive to monitor them. So what we have to see that on the one way, fine, theoretically is going to, maybe it is the profitability is going to enhance. Obviously there are several things we need to see, not necessarily that profitability will be increasing, because some banks balance sheet, maybe the net worth, they may be having lots of non-performing asset. However, overall we can see that maybe because of economic scale their profitability is increasing, but at the same time we also need to think that this merging or becoming too large, big financial institution is also going to aggravate the asymmetric information problem, and finally the long term it may adversely affect the smooth working of the financial system. Similarly here again you can see that many banks are getting merged, and the takeaway message for us here is that based on the analysis that we had, we can see that all these going to aggravate the asymmetric information problem, moral hazard here, and it may in the long term the financial system may collapse because of this bank merging. And we can see that there are now the competition is declining. Already we know that now we have only 12 scheduled commercial banks in India. So that means the number of competitive banks, the number of banks in the country is declining. As compared to US, for example, they have more than 5,000 banks. So that means that each and every banks in India is going to occupy its own stand. That means it's becoming an oligopoly market, and that means government won't allow. We cannot, not only government, the general public, or looking at the overall welfare of the economy, we cannot allow or any of these banks to fail. So obviously we know that it is aggravating the adverse selection problem. So let us now see let us have a quick overview of the banking crisis throughout the world. We can see that one deposit insurance corporation, it was implemented in several countries. However, deposit insurance is not to blame for some of these banking crises. We know that we already saw that the government safety net, that also where the government stands ready to bail out troubled financial institution, that also contributed to the banking crisis. And we can see from this figure, we can see that the banking crisis throughout the world since 1970s. So the red color, you can see that this is systemic banking crisis is mostly in the US, North America, and also you can see here in the Russia, China, these countries, and also in Europe you can see that. So you can see mostly there was systemic banking crisis, and systemic banking crisis occurs when many banks in a country are in a serious solvency or liquidity problems at the same time, either because they are all hit by the same outside shock, or because failure of in one bank or a group of banks spread to other banks in the system. So more specifically, a systemic banking crisis is a situation when a country's corporate and financial sectors experience many defaults, and financial institutions and corporations face great difficulties paying contracts on time. Then the episodes of non-systemic crisis, you can see in these areas in India as well, in Australia. So non-crisis only few places, and there are insufficient information in some countries. This actually the bank failure which we have seen that government is willing to bail out banks, because bank failure that we have already discussed many times, that means we cannot allow banks to fail, too big to fail problem. So actually the bailout package, it cost a huge amount, lots of cost on the society. So I am showing you the table, that means how much cost the bank failure, the cost of rescuing banks, how much it cost. For example, in Indonesia during 1997 to 2001, as per the estimate, the cost was 57% of the GDP. So from this itself we can see that how important this bailout package, how the government is according priorities, or that means according importance to this bailout program, because you know that actually this much money they spend in the rescuing of banks. So we can see these are all the other countries, Argentina, Thailand and all. You can see the cost as a percentage of GDP in the bailout program. So you can see China, they spend 18% of the GDP in 1998, and Norway, they spent 3% of the GDP in 1991-93 period. Then during the global crisis of 2007-2009 period, Iceland, they spent 13% of the GDP, and you can see, for example, US 4% of the GDP was spent for the as a response to to rescue the banks. So what we have covered so far is mainly the social safety nets and how it contributed to the bank failure. I would say social safety net and deposit insurance corporations and government standing as a lender of the last resort. We saw that it actually aggravated, it also aggravated the problem of asymmetric information, and many banks failed. Even bank fail, again government is further ready to stand out to the bail them out. Now we also saw here actually many governments, many countries, they spend a lot of public money in order to rescue the banks from collapse. The ultimate objective was to prevent the collapse of the financial system, or to prevent the financial crisis. Now let us continue this discussion by seeing what are the different types of financial regulation that can be further aimed at lessening this asymmetric information problems and excessive risk taking in the financial system. Because what we can see that because government cannot give up the banking system and the financial system, if there is a serious financial crisis is popping up, then it is the duty of the responsibility of the government to prevent them. So anyway they will be bailing it out. However, governments across the globe, countries across the globe started further regulating the financial market, because the thing is that then they understood that they have to further lessen the asymmetric information problem and excessive risk taking in the financial system. So as a result, the regulatory bodies put up several types of different types of financial regulation, and overall we can summarize, put everything into 8 types of financial regulations. So number wise you can see capital requirements, and second one is prompt corrective actions, restrictions on asset holdings and chartering and examinations, and assessment of risk management, disclosure requirement, consumer protection, and restrictions on competition. So these are the broad types, 8 types of financial regulations, and across the globe by country we can see that some countries will be putting depending some of this regulation more heavily. Not that all the 8 types of financial regulation is universally prevalent. However, most of the countries will be following most of these, and for example, starting with the first one, capital requirement, there is universally, that globally there is some agreement that what should be the capital requirements of the banks, what are the required requirements that each bank, the banks across the globe, means each country should be following. There is a globally required standard. So let us discuss this one by one. First, starting with the capital requirements. Coming to this one, capital requirements, this is the government imposed capital requirements are one way of minimizing moral hazard at financial institutions. So, when financial institution is forced to hold a large amount of equity capital, the institutions has more to lose if it fails, and is thus more likely to pursue less risky activities. This point we have seen in one of the previous session, because where we discussed that capital functions as a cushion when bad shocks occur. That means making it less likely that a financial institutions will fail, and thereby directly adding to the safety and soundness of financial institutions. Here the capital requirements for banks take two forms. The first type is based on the leverage ratio, that means the amount of capital divided by the bank's total assets. So, that is the leverage ratio, that is one. So, the leverage ratio, that means a well capitalized bank. So, accordingly based on the leverage ratio, we can categorize broadly, we can categorize bank into three categories. One is well capitalized banks, that means a bank's leverage ratio of 5% or greater is called as the bank is a well capitalized bank. And another is adequately capitalized bank, that means a bank's leverage ratio of 4%, that is amount of capital divided by the bank's total assets. If it is 4%, it has been termed as, classified as adequately capitalized bank. And then called undercapitalized bank means a bank leverage ratio less than 4%. These banks, a lower leverage ratio, banks with a lower leverage ratio, that means undercapitalized bank, especially one below 3%, triggers increased regulatory restrictions on the banks. That means restrictions on asset growth, restrictions on new branches, and on new lines of business. So, there is another concept called that the framework, that the capital adequacy is from the Basel framework. Basel framework means the Basel committee, initially named as the Committee on Banking Regulations and Supervisory Practices, was established by the central bank governors of the group of 10 countries at the end of 1974. So, this is the committee's first meeting took place in February 1975, and the meetings have been held regularly three or four times a year since. It was actually now several countries are members of this Basel framework, where the heads of the appointed authority of central banks of each country, they meet together at Basel. Is a city near to Germany. So, it is in Switzerland and border to Germany. So, the committee headquartered at the Bank for International Settlements in Basel was established to enhance financial stability by improving the quality of banking supervision worldwide, and to serve as a forum for regular cooperation between its member countries on banking supervisory matters. So, the representative of central banks across the globe, they meet to Basel, and then they develop the framework or regulatory framework, and one of them is the capital adequacy part. So, here the committee has established a series of international standards for bank regulation. Most notably is landmark publication of the Accords on Capital Adequacy, which are commonly known as Basel I, Basel III, and most recently, especially after 2007-8 crisis, as a response to 2007-8 crisis, there is Basel III Accord was also published. So, you can get more information of Basel regulation by visiting RBI website. So, coming to especially Basel III, it clearly laid out the requirement of Tier 1 capital ratio. It is a key measure of a bank's financial strength that has been adopted as part of the Basel III Accord on bank regulation. So, Basel III, it has mostly laid on the Tier 1 capital ratio, and Tier 1 capital ratio of a bank is the ratio of bank's core Tier 1 capital to its total risk weighted assets. This is the new measure that is used to regulate, ensure the bank's capital requirements, that the bank capital requirements. So coming to that, the bank's core tier 1 capital, and let us see what is bank's core tier 1 capital. So the core tier 1 capital is bank's equity capital and disclosed reserve. This constitute the tier 1 capital. And coming to the assets especially loans and other related assets, borrowings etc. by the bank. So these also need to be risk weighted assets. So risk weighted assets are the assets that the bank holds and that are evaluated for credit risk. That means assets are assigned a weight according to their level of credit risk. For example, you can see that the vault cash with the bank and the reserve with the required reserve and excess reserve with the central bank, it will be weighted 0. They are asset, but it will be weighted 0 because there is a 0 risk. While mortgage loan, you know that there is a high default risk. It can be based on the exact debt instrument, the loan, it may be, for example, may carry a weight of 30% or 35 or 50% etc. based on their default risk, right. So this is so let us see based on this how to calculate the tier 1 capital ratio. Assume that a bank holds 5 million in core capital, that is the core capital means equity capital and disclosed reserves, and it has a total of 2 loans. For the sake of simplicity, let us say that they have only 2 loans, that is assets, one worth 10 million with a risk of 50% default risk and another worth 20 million with a risk of 70% default risk. So in this way, let us see calculate the tier 1 capital ratio. So you can see that this is the core capital, and we need to take the weighted risk weighted assets, that is actually the one with the 50% default risk, the second one 20 million with a 70% default risk, then multiplied by 100, then you can see the tier 1 capital ratio. From this estimate, it is 26.3%. Then what Basel III capital adequacy ratio, requirements say. So here prior to the financial crisis, most banks held too much debt and low levels of equity, and they lacked adequate capital to absorb losses resulting from financial crisis. The tier 1 capital ratio was introduced in 2010 after the financial crisis as a measure of a bank's ability to withstand financial distress. So Basel III requires that equity component of tier 1 capital should be at least 4.5% of risk weighted assets. This is the requirement given by Basel III, and central banks across the globe they will be following. Whoever is the member of this Basel III, India is a member, India follow Basel III framework. Then the Indian central bank RBI asks its member bank to follow this criteria. It tightened the capital adequacy requirement that banks are required to observe. So the accord categorizes regulatory capital into tier 1 and tier 2. Under Basel III, the minimum common equity tier 1 increased to 4.5%. It also increased the minimum tier 1 capital to 6% from 4% in Basel II. So the overall minimum regulatory capital ratio was left unchanged at 8%, out of which 6% is tier 1 capital. These are the definitions of the tier 1 and tier 2 capital. Tier 1, you can see equity tier 1, these are all the components, and the requirement is it should be greater than or equal to 4.5%, but it should be greater than 4.5%. The second one is additional tier 1 capital. This also introduced by Basel III. These are all the components included in that is a related surplus, additional qualifying minority interest and regulatory adjustment. So this should be greater than 6%. And then tier 2 capital, that means sum of capital instruments meeting the criteria for tier 2 and related surplus, additional qualifying minority interest, qualifying loan loss provision, altogether it should be greater than 8%. That is according to Basel 3. So the common equity tier 1 capital is also called as going concern basis, because this is the highest quality of regulatory capital, as it absorbs losses immediately when they occur. So tier 1 capital provides loss absorption on a going concern basis. At the same time, the tier 2, it is considered as a gone concern, because tier 2 capital is gone concern capital, that is when a bank fails, tier 2 instruments must absorb losses before depositors and general creditors do. Before we summarize, let us also have a quick overview of Basel 1, at least what is the Basel capital 1 capital accord. So at that time, the 1988 accord called the minimum ratio of capital to risk weighted asset 8% to be implemented by the 1992. So I am keeping some text here, the major principle that they followed in Basel 1 accord, that means bank must hold equity capital to at least a fixed %, and these are all the further provisions. This is only for your review, and the recent one, obviously you know that not Basel 3, that is the one which we discussed a couple of minutes before, that is the current requirement, that the current capital requirements in India as well, across many other countries, other banks in other countries who are following Basel framework. Let us conclude now, stop here and meet in the next session. Thank you.